Hello there everyone, today's video will take the first look at the autumn statement which has just been announced and my initial reactions to this. Now what I've done, I've actually been through the entire Green Book as it's known on the Treasury's website, which has got 120 pages of detail, and trying to condense that into a short video. So let's just dive straight in, have a look at the highlights of what is in today's autumn statement. So just a few economic indicators to kick off. This struck me. I mean, they have pages of blurb on this stuff in there, but the main headline is the amount of debt that we have in this country. So basically, our predicted interest expense, so the cost of servicing the national debt in this fiscal year to the end of 5th of April 2024, 116 billion pounds. 116 billion. To put it into perspective, that is the second most expensive thing that the government spends money on after the NHS, the health service and social care. That's at about 170 billion. The second highest then after that is on servicing the national debt. So this 116 billion, way in excess of what we spend on education or on defence or anything else. So it's a huge deal. Need to get that debt burden down. What else? Inflation. Thank goodness inflation is coming down. The forecasts are that it will get below 3% by the end of 2024. They reckon it'll be about 2.8%, and then hopefully back to the target rate, which has been 2% for years. That's always been the target. Hopefully the year after next. But we're on the right track with inflation at least, so that's a good thing. So Class 2 national insurance. If you're self-employed, you pay two lots of national insurance, Class 2 and Class 4. Now, Class 2 is like about £3.50 a week. It's a flat rate. And Class 4 is based on a percentage of your profits. What the Chancellor announced today said we're going to just absolutely bin off Class 2 national insurance. So that goes. So that £3.50 a week for self-employed, that will go from next year. This is from April next year. So that's a good thing, anything that goes. But strangely enough, when you think about it, you think, well, what gets me my entitlement to the state pension? Surely it was the Class 4 national insurance payments, which often can be thousands of pounds a year, not this 150, 170 quid a year on Class 2. But no, it was the Class 2 that was deemed to be contributory. In other words, you had to pay Class 2s to get your credit for state pension. Now that it's gone, the government have said, Chancellor said today, said, look, don't worry about it. If you've got profits as self-employed over 6,725, you will still be able to get your credit for state pension, even though you're no longer paying Class 2s because they've been abolished. If you weren't at that level anyway and you were paying voluntary Class 2 national insurance for state pension because your profits weren't big enough to mandatorily pay it, well then for the continuation, that will continue for a while, that you will still pay Class 2s. Then the government are going to bring in some change to the system where you don't have to do that. There'll be some alternative. But basically, Class 2s being abolished. What about Class 4s? I mentioned Class 4s. That's the other NI that self-employed people pay. Well, the rate at which you pay Class 4s is 9% between 12.5 grand and 50 grand. That 9% is being reduced to 8%. So 8% going forward is the Class 4 national insurance rate. Okay, the big sort of rabbit out of the hat, the one that's costing the government the most, but which will appeal, they hope, to 27 million people, is the reduction in the Class 1 national insurance. So if you're an employee, you pay Class 1 national insurance, and the main rate at the moment is 12%. He's not dropped it by 1% like he has with Class 4s for the self-employed. He's dropped it by 2% from 12% to 10%, which is quite a big deal. It'll cost about 8 billion a year after the first few years. However, national insurance is just another tax. It's just another income tax to all intents and purposes. So when you talk about someone being a lower rate taxpayer at 20%, yes, but then they were paying 12% NI, so really they were paying 32% tax. So all he's done is just knocked a couple of percent off that. It's still 30% tax that a basic rate taxpayer is paying. 20% income tax, 10% national insurance. However, welcome relief, I'm sure, even a modest drop, or not so modest, depending on how much it is, but 2% for all of the employees, not a bad thing. So, what have we got? Pensioners, triple lock. Chancellor reaffirmed the government's commitment to maintain the triple lock. There were lots of talk that they would rescind or renege on their promise to do that. I doubt it. Only several months away from an election, so that is in. And because wage inflation has been so high, the increase in the state pension next year, 8.5%. So triple lock being maintained. Full expensing relief. This was basically an introduction that was brought in at the budget 8 months ago to appease larger UK businesses for the fact that the headline rate of corporation tax jumped from 19% to 25%. So the government said, look, don't worry, because all of the millions of pounds that you spend on equipment and machinery, where we used to curtail the tax relief on that investment, we used to let you write some of it off, but we're going to let you write the whole thing off for the next 3 years, which went some way to alleviating the pain of having to pay an extra 6% corporation tax on profits. Now, what he did today, he said, look, that temporary introduction that I only brought in the spring, we're going to make that permanent. So that full expensing relief will be a permanent fixture in the UK tax code. But like I said, it only really applies to the big corporates. What I've got a gripe about, which really upsets me and thousands of other self-employed people who have their own limited company, is that we're having to suffer this increase in corporation tax from 19 to 25%, but there's no quid pro quo like there is for the real big corporates, and that we're not going to be spending millions on plant and machinery. So we're not going to have anything to really set off the increased headache of having a higher headline rate of corporation tax. So there was nothing announced today which talked about reducing the headline corporation tax rate, only the fact that increased or permanent expensing relief for the big FTSE 100 companies. So nothing for SME companies. Because these other announcements for self-employed, bring down national insurance, well, a lot of taxpayers who have their own limited company pay themselves on what's known as the minimal salary maximum dividend route, where you get a credit for state pension anyway without paying any national insurance, and you're paying the least amount of income tax because you're paying yourself a dividend, which doesn't attract national insurance. So the NI reductions of class 1, abolishing class 2, reducing class 4, they don't apply, they don't impact business owners who have their own limited company, of which there are tens, if not hundreds of thousands of them in the UK. So nothing in it for the small companies to shout about. What else? New investment zones, East Midlands, West Midlands and West Yorkshire. These are basically designated areas where the government have said, look, if you come in to start your business in here, we'll give you added tax breaks, super fast broadband, reduced business rates, that sort of thing. So more areas are being designated today. Okay, what else have we got? Pension pots. Yeah, this is a good thing. So there is a problem in the UK with what we call multiple pension pots, and I've done separate videos on this. The fact that people are more transitory in their working life. The average person will work in about 8 or 10 jobs over a 40-year career, where in the past it was maybe just one or two, a handful. The point being, because you've also got mandatory auto-enrolment, they will build up multiple pension pots over the course of their working life, and often they can't keep tabs of them. So the government's trying to bring in this thing called a pensions dashboard to monitor them, but that's just in terms of finding where they all are. But what they're trying to do to solve the problem of having multiple pots is say, look, when you start a new job, we will make it mandatory for your employer to pay into your auto-enrollment pension of the pension pot of your choosing, i.e. an existing pension pot that you may have. Because how it works at the moment, if you're a boss of a company, you take on a new member of staff, you have to pay into a pension pot under auto-enrollment. Certain percentage of their salary you got to contribute and they got to match. Now, where you choose as the employer, you don't have to give them an old singing, old dancing pension scheme. You can do it into a basic pension scheme, whatever's right for you as the employer. There's minimum requirements just on the amount that you've got to put in. Doesn't need to be what's necessarily the best performing fund, and there's certainly no obligation for that money that you have to pay to go into an existing pension pot of the individual who's just joined your firm. That's what the government is talking about today, making that a law that says if your new employee says, look, boss, can you pay into my existing pension that I've got? In theory, the boss shouldn't be that bothered because it's still costing them the same amount. The 3% of the salary, whatever it is just going over here instead of over there. But that will go a long way to reducing the problem of multiple pension pots if people don't just have a pot for every single job they're working for 30 or 40 years. So it's a good idea. Right. R&D. R&D has been around for many years, several decades. It keeps changing. It's quite complicated. In actual fact, there are two separate schemes. There's what's called an SME scheme, which, as the name suggests, a lot of SMEs use. There's also a different type. It's called an R&D expenditure credit, used mostly by larger companies, listed companies. And you've got these two separate regimes looking to incentivize the same thing. It's all about giving tax breaks for research and development. And what the government has said, look, we've had these two parallel schemes for years. Let's just create one universal system for R&D, and we'll bring it in from next year. Now, interestingly enough, they're not merging, say, one of them into the other. They're taking the best bits from both and combining it, although they haven't said exactly how they're going to do that. But when you look at in the little green book in the costings of the Treasury, which I'll just have a look at, it's actually a net benefit to the taxpayer, which means the government, think they will be out of pocket by doing this merger. In other words, they're not going to take away from the taxpayer what was already there. It's actually going to cost them money. So when they combine these two schemes, it's going to be more beneficial in their budgeting for the taxpayer. So that's not a bad thing. Better it going that way than the other way, where you're going to be worse off. So let's just wait and see the details of the new R&D, the combined R&D scheme coming in the spring of 2024. Now, government exit NatWest. This got a bit of a laugh in the house, and Jeremy Hunt said, we want to get SID back investing for those of a certain age, i.e. my age or older. There was a big advertising campaign in the 80s when the government at the time privatised a lot of the state industries. One of them was British Gas, a very successful advertising campaign, all about if you see Sid, will you tell him? Many of you remember those series of adverts. And that what Jeremy Hunt was referring to today. What if you see Sid, will you tell him, get him back investing? Government will be looking to get rid of their share in NatWest, which they took on 15 years ago or so. So look out for that next year if you want some shares in NatWest. So what have we got here? ISAs. Extending the opportunities of what you can put in ISAs. No announcement in terms of increasing the threshold. Many commentators thought, is he going to up it to 30 grand a year? Remember, you can do 20,000 a year. So that's still going to be 20 grand a year, but the choice in terms of what you can put in is going to extend to more niche, esoteric areas, being long-term asset funds and open-ended property funds. So apparently you couldn't invest in either of those two things right now, but from next year, you will be able to. I mean, you can still invest in umpteen different types of stocks and shares, but just a very specific couple of things have been added to the list that you can invest in within your ISA wrapper. Okay. Here's an interesting one. Tax returns. Currently, to do an income tax return, there are certain requirements that you have to do one, regardless of how much you earn. If you have things like buy-to-let property, you've got to tell the government tell the HMRC how much rental profit you're making. The way you do it is to do a tax return. But also, just assume you didn't have any other income other than a job. So you've got a P60 with some employment income, PAYE deducted, and that is it. The rules at the moment say you only have to file a tax return if you've only got employment and you earn in excess of 150 grand a year. So that's crept up. It was a few years ago, that used to be 100,000. Now it's 150 grand. So let's say you got one job, you're earning 155 grand a year, you've got to do a tax return. If you earn 149 grand a year, you don't have to do a tax return. Now, what the government announced today, didn't say it in the House of Commons, it's not particularly rabbit out of the hat kind of moment, but it's buried in the detail, but it's a big deal to the tax profession. That limit from the next tax year, 24-25, will be abolished, meaning regardless, if you earn 200 grand a year or £1 million a year on your P60, that would be marvellous, wouldn't it? But if you, regardless of what you earn on your P60, if you just have income from employment, there is no requirement to file a tax return. This means 338,000 people will no longer have to do tax returns. Okay, so great for those people who earn the money and think it's an absolute ball ache to have to do one. But people in my profession, that's 338,000 fewer clients, unfortunately. But there you go. That's just HMRC changing the rules. So that's interesting. So that basically means you can, working backwards, you say, well, how many people in the country earn more than 150 grand? Well, that tells you 338,000, there or thereabouts. So yeah, interesting. But that comes in from next year. What else have we got? The Chancellor made a thing about encouraging the self-employed people. He said, look, people who are self-employed help the economy keep going in lockdown. And, one of the things that he announced, like I've already said, is the reduction in the class 4s, abolition of class 2s. And also they've announced they will extend what they call the cash basis for preparing accounts and tax returns. So at the moment, under certain circumstances, you prepare your accounts as a sole trader as if everything's done on the cash. You've received whatever you've spent, whatever you received, rather than what we call an accruals basis, which means, your invoice date rather than the date you received the cash, and likewise on your expenditure. So that mechanism for declaring and reporting the cash only basis is being expanded. So more news on that if you're a sole trader. And last but not least, something that caught my attention was the CIS gross status test. So if you are a subcontractor working in the construction industry, depending on your record, your track record with HMRC, will depend on how much withholding tax your contractor must withhold from your payments on your jobs. So if you have gross status, that's the ideal. That's what you want. If you are in business, you're a subcontractor, but you're working for someone else, to have gross status means that the contractor will not deduct any tax from you. You'll receive the amount gross and then settle it with HMRC on your tax return at the year end. If you haven't, for whatever reason, your compliance has been bad, you've been late with tax returns, you're a late payer, whatever, HMRC give you a little black mark and say, no, you can't have gross status. Instead, the guys who are paying you need to withhold 20% or 30% tax, and they pay it to us rather than we trust you to pay it to us 9 months down the line. What's been announced, or what's been buried in the Green Book, is that those gross status tests will now include VAT. So remember, CIS predominantly concerned with direct taxes, income tax, corporation tax, notwithstanding the fact we also have reverse charge for VAT within the CIS regime now. But that your VAT history will now have a say on whether or not you're granted gross status or not if you work in the CIS, whereas before they didn't take it into account. So just something a bit more onerous there, more hoops you've got to jump through and comply with if you want to have the gold standard, as it were, the gross status, if you are a subcontractor. So, an overview there of 120 pages of detail in the autumn statement. The big headline grabbers was a reduction in the Class 1 national insurance from 12% to 10%, which will impact 27 million working people, which ain't a bad thing. So, if you like this video, please do subscribe, and as always, I'll see you soon.